Great. Thank you so much. Happy to be here. It's fabulous day in Atlanta. Looking forward to presenting just a few things today to hopefully put you in the step going forward to your financial freedom. So, appreciate the introduction. A little bit more about where we are at IRC. We believe that everyone can grow their wealth, everyone can become financial free. The key ingredients to your financial freedom really starts with two simple items. First and foremost is knowing where you're going, having a destination, and then number two, creating a plan or a roadmap to get there. We believe in simple roadmaps, which include saving each year, two, get out of debt, three, be risk averse, and four, always make sure you have plenty of cash. So we're going to be talking today about the first item on our tactical roadmap, which is all about saving. And before we begin talking about saving, let's back up for a moment and let's put you in control of your finances. We always say here at IRC that our emotions control 80% of our decision making when it comes to our finances. So, one of the first things that we want to do is acknowledge how emotions impact what we do when it comes to creating our plan as well as executing our plan. So we're going to be talking about that first. But the first three things that we're going to talk about today is we're going to talk about creating cash and how that makes you less emotional about your money. Number two, the best ways to actually start to save. And number three, some basic information that you need to know about investing your money. We always say here that education is key, and I so appreciate you taking the time to get a little bit more educated about your money. Because as we say, the more you know about your money, the better decisions you're going to make. Recognizing it's not one great decision that you make to become financially free, it's a series of good decisions. The first decision or first thing that you need to know about your money is all about cash and why cash is so important when it comes to your financial plan. Now, everyone has heard about the normal or traditional safety net conversation about cash, that you need cash in your checking account for potential job loss, maybe an emergency medical expense, some unexpected large purchase, repair on your house, for example. But we want to take it a step further. We want you to have cash in your checking and savings accounts that allows you to become less emotional about your money. Because what we know is if you have a cash safety net, that if you know that when that an unexpected expense comes along or that job loss comes along, that you're still going to have cash to meet the basic needs and necessities of life, then you become less anxious when it comes to your money. And we want you to become less anxious because we want you to don the hat of a CFO. You're the chief financial officer of your finances. Why do we want you to become more objective? Because it allows you to focus on the objective things that you can control about your money instead of being whipsawed by the emotions and the subjective items. You make better decisions when you're objective about the goals and destinations that you're trying to reach. This objectivity allows you to focus first and foremost on your monthly cash flow because really it is simple. In order to save, you've got to have more money coming in than going out so that you, at the end of the day, end of the month, you have money left over. And we call money left over positive cash flow. So that if you have cash in your checking account, you're less emotional about the ups and downs of the market or this expense or that expense. You can objectively look at here's what's coming in, here's what's going out. Where can I either increase my income or decrease my expenses to increase my positive cash flow? And the amount of cash flow allows me to save. So now that you have positive cash flow. Now that you can save, let's talk about the best ways to save. First on the list, we always look at someone's 401k plan if they have access to a 401k plan. The 401k plan in our mind is the best way to save for several reasons. First of all, you're saving using pre-tax dollars. Well, what exactly does that mean? It means that if you save $1,000 a year in a 401k plan, that after tax, had you actually taken the money, you would have only received somewhere between $700 and $800. So being pre-tax gives you the ability to save 20 to 30% more money each year for free. Again, going back to that emotional side that we talked about earlier, everyone loves free money. And the tax man, if you put your money $1,000 saved after tax, is going to equal $1,300 saved pre-tax. Everybody likes more money. That's the first reason. The second reason, if your company or employer provides you a company match, that just means more free money for you. You put in 4% of your wages, your company matches you 4%. So now that $1,000 that you put in now is $2,000 because your employer gave you an additional $1,000 as an incentive to continue to save. So far, just objectively, the $1,000 that you would have taken as payroll, which is really going to be $700, I always ask questions, the direct question, client, would you rather have $700 in your investment account or $2,000 in your 401k? Pretty easy decision if you're looking at it objectively. Other reasons why the 401k plan is so effective is that it comes out every 2 weeks or every month or 1st and 15th, depending upon how you're paid. And that $1,000, which may sound like a lot of money if you're paid 1st and 15th, is really only $41 every paycheck. So it's a small enough amount that it doesn't hurt. And you never really feel it because of the second reason. If you're taking it out pre-tax every 2 weeks, it never hits your bank account. We've had client after client after client come in with $300,000, $400,000, $800,000 401k rollovers into their IRA when they retire. I always ask the question, did you ever feel that money coming out of your cash spending? And they said, no, because I never saw it. It never ended up in my checking account, so I never felt it. And the third reason is that a 401k plan is going to give you something that's referred to as dollar cost averaging, which means you're buying into your investment allocation of 401k dollars every 2 weeks. So when the market is down, when you really don't want to invest, but you know you should invest, the dollar cost averaging forces you to buy low and not buy as much when the market is up or higher. So everyone's heard the phrase, let's buy low and sell high. Dollar cost averaging forces you to do that. Okay, so great benefits. The 401k, no question about it, has tremendous benefits for most people. Now, if you don't have a 401k plan, you can still have almost all of the benefits using other retirement plan accounts, whether it's an individual retirement account, IRA, a SEP account, simplified employer pension plan, or a simple account through your employer. There are different types of retirement accounts that you can get most of all the benefits that you would normally get in a 401k using these other accounts. So just because you don't have a 401k at your employer, you need to be aware that these other benefits, pre-tax, company match, systematic monthly contributions, are available to you in other plans. Don't have a 401k, don't have a retirement plan at work of any kind, you can still get some of the benefits of having a regular investment account that you put money into every week, every 2 weeks, every month. You get the systematic, you're putting in smaller amount, it automatically comes out of your checking account into your investment account. You get dollar cost averaging. So you have multiple ways to save. We've just prioritized them for you. 401k probably being the best, IRA accounts being the second best, and regular investment accounts still being a great option for you. So you built your cash safety net. You've become the CFO of your money. You're now learning about your money. Your expenses are less than your income. You've got positive cash flow. You're putting money into your 401k or your IRA or your investment account. Now the question really becomes, but what do I do with this money? Think about your account, your 401k, your IRA, your investment, as simply your suitcase. The clothes inside your suitcase are actually the investment choices that you make. And if we boil down your investment choices, again, it's rather simple. You have three basic options to think about. Number one is you can take all your money in your 401k and just keep it in a cash account. Or you could invest in bonds or fixed income. Or you could invest in stocks or equities as they're known. Now let's review the basic principles of these three items. Now, first of all, your first option is always cash. You can put it in the account and just leave it there. And you know what? Cash makes you feel really good from an investing standpoint. You put $100 this month, $100 next month, $100 3 months from now. So now you're $100 every month. 3 months later, you've got $300, and your account is growing from the contributions you make. And there's no volatility. There's no upside, and there's no downside. So it makes you feel good. But it may not be the best investment option if you have at least 5 years or more to go before retirement, or for whatever your money that you're saving for is going for, is because cash doesn't actually provide you any rate of return. And unfortunately, cash by itself is actually losing money each year because of inflation. We tell people all the time, inflation is like my bald head. When I was in college, I had a full head of hair. As I graduated and kind of went on my working career, slowly but surely I lost my hair. If I kept looking in the mirror just the same way, turn the lights down, I could convince myself I still had hair, but really I didn't. It wasn't until last September when I was on vacation, as the sun was setting and I was sitting there admiring the sunset with my companion. I said, I'm going to shave my head. And she just looked at me and just kind of nodded and laughed. And I came home and did it. Inflation eats away at the purchasing power of your dollar at a rate of 2 to 3% per year. You don't notice that your dollar buys less and less and less for a 3 to 5 to 10 year period of time. So as an investment tool, cash is not necessarily the best tool for us. It makes us feel good, but if we're really objective, if we're really being the CFO and CEO of our money, we've got to realize that's really not a long-term good place to put our money. So if you're not going to invest in cash, you have to decide where your money is going to go. And I think a lot of people know about bonds or stocks. Sometimes they're referred to as fixed income versus equities. I like to boil it down into a decision. Would you rather be a lender or an owner? Now, both of these opportunities provide upside, but you need to know exactly what you're getting yourself into. So let's take an example. If you went out to buy a home and you selected a $500,000 house, you would go to the bank and the bank would lend you $400,000. And let's just say that you got a fixed 3% interest rate and it was interest only. So the lender is the bank loaning you 400,000. You as the owner, you're buying the house for 500,000. You're putting $100,000 down as the equity as the owner. And your rate of return is to be determined. So 5 years later, you get transferred and you decide to sell the house. So you go to the closing table. Who gets paid first? Well, of course, the lender does. The lender gets their $400,000. They're happy because you paid them 3% interest every year, and they go along their way. You, as the owner or the equity participant, you're pretty happy. You bought something for 500, you sold it for 600, you actually invested 100,000, you get $200,000 back. Your compounded per year rate of return is almost 15%. So you're feeling pretty good. 15 is a lot more than 3. And you're paid more, you make more money because you're taking the ownership risk. You get paid second. When it really boils down to lender versus owner, it's who gets paid first based upon sale or based upon liquidation. So far in this example, you feel pretty good and you want to put all your money as an equity owner because the potential to make more money. Now, in the next example, you buy the house for 500,000, but you sell it for 450,000. You go to the closing table, the lender gets their 400,000, their 3% per year positive rate of return. You as the owner, you invested 100, you only receive back 50, you've had an economic loss. It's the real key difference because you're getting paid second. You're taking more risk when you invest in ownership, in equity, versus being a lender. So the trade-off between the two is, as a lender, you're going to get paid a fixed rate of return. It's going to be stable, and the rate of return is going to approximate inflation, maybe a little bit more. So you're getting paid something, but you're not really making a return that's in excess of inflation. So if you're not making a return that's in excess of inflation, you're not creating any real wealth. As an owner, you have a potential for a higher rate of return, which comes with volatility of up and down. But your goal is not only to make a rate of return that equals inflation, but that is above inflation. So that 5 years, 10 years, 20 years down the road, your savings after inflation has produced a positive rate of return. And that's how we create wealth. So we're not going to be able to get into all the details of how to allocate your 401k and or your investments or those types of things, but looking at it from a wholesale standpoint of saying, okay, at least I have the basics in mind. What you want to do is always start from the basics, from the most simplistic manner, and build on your wealth of education so that you can start making more informed decisions. You know, one of the things that we love doing is providing information to people. And if you would like, I wrote a book. As I tell people, it took me 5 years to write it. It'll take you 5 minutes to read it, but it takes basic, simple principles of wealth building. And if you text 4422, or I'm sorry, text IRC Wealth to 4422, and we'll send you a follow-up email that'll allow you to get that texting instructions. We'll send you a free electronic copy of the book to help improve your basic education, because education is the key to you making good decisions, and making good decisions over time is the key to building your wealth. So I'm going to pause here for questions because I love this stuff. I can talk all day.
Thanks, David. That was great. I'll remind everyone if you have a question, you can use the chat box or you can email info@savvyladies.org. And we had some questions come in. So the first one here is, what are some creative ways to come up with money for a down payment on a house? I just don't have enough money saved up for that down payment yet.
Great. A couple things that just had this happen the other day. Uh, Family is always a good source to go to if you have that potential. Uh, Second jobs, I see that happening out there, babysitting. Those are other types of ways to create other additional income. Quite honestly, the easiest way is to go back through your personal monthly expenses. It's amazing that when we sit down with clients, the first thing that we do is we just take an objective, non opinionated look at where they spend money. And I would say 80 to 85% of the time, people don't know where their money is going. So the best place to start is the exercise of taking the last 3 months worth of check registers or Quicken or what you're spending and just write it down. It's amazing how many eye-opening conversations that we have and that people recognize, I didn't know I was spending that much. I didn't know that that was happening. Another place to look at after you've done that exercise is look at all these nickel and dime expenses. How much are you paying for cable? How much are you paying for insurance? These small amounts that seem to creep up year after year, month after month. Switch from dish to cable, switch insurance providers, go generic versus brand as far as drug cost goes. It's the $20 here, the $50 here that doesn't change your lifestyle. You're still getting the same cable channels. You're still getting the same medicine. Provides you the opportunity to reduce expenses that you may not know that you could have in the past. But the first place to start is writing it all down.
Okay, great. Those are some good tips. Another question for you is, if I don't have a 401k because I'm self-employed, what do I do or who do I speak to set up a SEP?
Great question. So, if you're self employed, you have a lot of different options. First of all, who do you talk to is generally any financial institution, whether it's Charles Schwab, Vanguard, your local bank. They will have all different types of retirement opportunities for you. If you're self employed, there's really four accounts that you should look at: the traditional IRA account, the SEP account that you mentioned, the simple account, and if you're the only person in the company, what's referred to as a solo 401k. Each of these accounts have tremendous benefits, but each of them have a little bit of a different twist on how much you can put in based upon your money and how much complexity that you have. So if you are self-employed, I wouldn't limit yourself just to a SEP. I would look at all four of those options.
Okay, thanks. Another question is, what are some regular brokerage accounts? Do you have examples, and what the difference is between those and 401ks and IRAs?
Great question. So really there's kind of three baskets. You have the custodian, which is the company that actually holds the account, which actually has the money in it. So the custodian could be Charles Schwab, TD Ameritrade, Vanguard, Fidelity, Merrill Lynch, Morgan Stanley. So first, you have to decide who the custodian you want it to be. And typically, you have two broad choices: a full service brokerage custodian, Merrill Lynch, Morgan Stanley, those types of firms. They're going to charge you higher fees, but give you more guidance versus more of a do-it-yourself, which is Charles Schwab, Fidelity, E-Trade, where the cost to have an account and the cost to transact business is going to be lower. So first you have to decide on where and who do I want to deal with. The second question is, what type of account do I need? Do I need a retirement account, which is an IRA, simple SEP, 401k, or do I just need a regular investment account and put money into and pull money out? So custodian first, what type of account second, and third, inside of the account, what are my investments going to be made up of? Am I going to be a lender? Am I going to be owner? How much cash do I want? How much bonds do I want? How much fixed income do I want? Those things that actually go into the account. So 3 basic choices.
Okay, thank you for that. Another question is, do you have any fixed income investment recommendations, or can you just talk about fixed income investments in general?
Yes, fixed income there's 2 ways to really invest in fixed incomes. You can either, if your account's large enough, you can actually buy the bond itself. So Coca-Cola, Home Depot, the US government issues fixed income or bonds. They're sold on the market. So if you want to invest 5,000 or 10,000 or 15,000, you're buying the direct obligation from one specific entity and the lengths of maturity. Think of a bond kind of like a CD that you get from the bank, okay? But instead of being 100% insured by the FDIC, it's not insured, and so it's not 100% guaranteed, but you get paid a higher rate of return to not have 100% guaranteed. So if you're buying the bond itself, then when it matures, you get the money. The upside is as long as you hold the bond, you won't ever lose principal as long as it matures and pays off. The downside is that you have less diversification because you're buying one bond from one company or multiple bonds from multiple companies. You can also invest in fixed income or bond ETFs or mutual funds, where then you're paying a fee to a manager who is going out and buying a bunch of bonds, and he's buying a bunch of bonds for a bunch of people. The upside here is you get professional management, you get diversification of the investments, but the bond fund never matures. So you do take a volatility risk when you're actually buying the mutual funds if you get out before a certain point in time. So a direct recommendation we can't make in this presentation, but the recommendation would be either decide to buy bonds directly if you have a large enough account, or go into a bond fund, mutual fund, or ETF.
Okay, great recommendation. Thanks. So for this last question, I just want to start by saying that whenever we survey the Savvy Ladies community, understanding investing is always a top interest. We always see that. So I'm going to combine some of the questions we received today and questions we've gotten in the past as well. If someone has a 401k, enough money in their emergency fund, and no credit card debt, do you suggest opening up something like a small trading account, maybe on E-Trade or Schwab? Is that a good way to start investing in the stock market, or do you have some other recommendations?
Okay, so our recommendation, we believe in balance. You know, a life person's balance. You can't work too hard, can't play too hard, back and forth, those types of things. When it comes to, okay, so you've done a great job, you got enough in your safety net account, you're maxing out your 401k plan, your spouse is, if you have one, is maxing out your 401k plan, and now you still have excess money and no credit card debt. For every extra $100, take half of it start what's referred to as a regular investment account, or as you refer to, a trading account. Then take the other half and put it against your mortgage. We're a big believer in, yes, you need to have more money in retirement. So saving more is always better. But remember, in retirement as well, if you finally get all your debts paid off, including your mortgage, the amount of money that you need in the end is always less. Okay. And you get a guaranteed rate of return when you pay off a mortgage. So if you're paying 4%, 5% on a mortgage versus if you get a five, you can get guaranteed returns of 5%. Plus, the emotional impact of never having a mortgage in retirement is just as beneficial as, yes, set up a Charles Schwab account, set up something that you can, if you're not working with a financial planner directly, this way you can actually start investing in broad-based ETF funds for long-term growth. You can see it growing, and you can set up auto investment plans just like your 401k. It just doesn't have the tax benefits.
Okay,
I would
great.
say, let me add one other thing
Oh,
too,
sure.
is change the slide. So on our website, listed ircwealth.com, we have a library of educational materials. So if you have follow-up questions, whether it's on investing, or should I pay my debt down, or how do I pay my credit cards off, or I need to care for a spouse, I need to care for adult my parents are aging, insurance question. So there's a library of free 100% free material you can go and download. Not only our blogs, but Joe Shum, as part of IRC Well, does a bi-weekly podcast. So you can go and search our library for any topic that you want to hear experts that we have, both within our company, but also within our community. So Joe has interviewed probably 30 or 40 or 50 experts on different topics that you get to hear directly from them what their advice is, and it's all free.
That's excellent. And we'll be sending out this information to everyone as well. Also the texting information for your digital copy of the book. So I want to thank you, David, for a really great presentation. And I encourage everyone to check out David's website, as he mentioned, for more resources. Thanks to everyone who joined us today and asked questions. We hope you'll be joining us again. Thanks so much, David. And thanks, Joe, for your help in putting this presentation together as well. Thank you so much.
Thank you.